Hello everyone. Now let's talk about the treasury stock. And treasury stock is the stock when the corporation buys back its previously issued stock. So we call that like reacquisition of their own stock. So if a corporation buys back its own stock, that would reduce the number of shares outstanding. So we always say issued stock is equal to, or outstanding stock equal to issued minus treasury. So a corporation may reacquire or purchase back its own stock for different reasons. Some of those reasons could be providing shares for resale to employees, or reissuing as bonuses to employees as well, or supporting the market price of the stock. If the market price is going down and they feel like it's undervalued, then they try to create some more demand by buying back their own stock. The cost method is normally used for recording the purchase and resale of treasury stock. So under the cost method, treasury stock is debited for the cost or the purchase price, and any difference between the cost and the selling price is debited or credited to paid-in capital from the sale of treasury stock. So we'll see an example for that. So assume a corporation has the following paid-in capital on January 1st of whatever year. So on common stock of $20 par value, they have 20,000 shares authorized and issued. So 25,000 or $25 multiplied by 20,000, that's 500,000. The excess of issue price over par is $150,000, which is the additional paid-in capital. So the total value of the paid-in capital is $650. The corporation entered the following treasury stock transaction. On February 13th, they purchased 1,000 shares of its own common stock at $45 per share. And then later had two sale transactions for these 1,000 shares. So they sold on April 29, 600 shares at a higher price, which is $60. And then they sold the remaining 400 at a lower cost than, or the lower price than the cost, which is $40 compared to the $45 they acquired it for. There were no dividends, cash or stock that were paid on the sales on the shares of the treasury stock. So let's see how this would be affecting the journal entries, or how we can record the journal entries on these specific dates. So when the company acquired its own stock, we're going to debit treasury stock. And by the way, it's tempting to think that treasury stock is an asset, but it's not an asset. It's actually a reduction of equity. So as you know, equity belongs to the credit side. So whenever we're recording the treasury stock on the debit side, we are actually reducing equity. So they purchased 1,000 shares at $45. So we debit treasury stock for $45,000. And again, that's a contra equity account. And we credit cash for $45,000. When they sold the 600 shares at $60, the amount of cash received on April 29th would be 60 multiplied by 600, which is $36,000. Then we credit treasury stock for the 600 shares at 45, which is the cost, and that's what we apply in the cost method. Forget about the par value and all these kind of things now. Whenever we're dealing with treasury stock based on the cost method, we're going to use the purchase cost, or the purchase price for the treasury stock, which was the 45. So we take 600 multiplied by $45, and that's $27,000. The difference between the 36 and the 27, which is $9,000, that's going to be treated as paid-in capital from sale of treasury stock, which is again part of the paid-in capital. On October 4th, when we sold the remaining 400 shares at a lower value than the cost, which is the $40, we'll start with debiting cash for 400 multiplied by 40, when that's $16,000. Then we credit treasury stock based on the cost, which is 400 shares at 45, and that will give us $18,000. The difference in this case would be a reduction in the paid-in capital, and it's going to be debited to paid-in capital from the sale of treasury stock. Now let's see how we report the stockholders' equity. So, as with other sections of the balance sheet, alternative terms and formats may be used in reporting stockholders' equity. Changes in retained earnings and paid-in capital may be reported in separate statements or notes to the financial statements. So there are two methods for reporting stockholders' equity. The first method, where each class of stock is reported, followed by its related paid-in capital accounts. Retained earnings is then reported, followed by a deduction for treasury stock. I personally like this method because it's very organized and it shows the additional paid-in capital related to each category of the stock. The second method simplifies things a little bit. So the stock accounts are reported, followed by the paid-in capital reported as a single item. So additional paid-in capital, which is combining everything together. Whether the paid-in capital is from common stock, preferred stock, treasury stock, they're all combined together. Then retained earnings is then reported, followed by a deduction for treasury stock. So let's see this presentation. So as you can see here, under method 1, we have the paid-in capital, where we have the preferred stock, and then the excess of issue price over par, which is the additional paid-in capital for the preferred stock, and then we get the total. Then we have the common stock, and again, we have to present the par value, the number of shares authorized, the numbers issued, and that will get you the value of the common stock, and then the excess of issue price over par, which is the additional paid-in capital for the common stock. And then you get the total, which is 1,090. And then you have paid-in capital from sale of treasury stock, which is the $2,000, and then the total paid-in capital, which is $1,202,000. Then you add the retained earnings, and you get the total, and then at the very end you subtract or deduct the treasury stock value. And that will give you the total stockholders' equity. So that's the sequence under method 1, very, very detailed. In method 2, we just show the contributed capital as preferred stock, common stock, and then additional paid-in capital as a value that combines everything. So the $202,000 is just the paid-in capital related to preferred stock, common stock, and treasury stock. And then, once we get the total contributed capital, we add to it the retained earnings, we get the total stockholders' equity, then we subtract the treasury stock to get the total stockholders' equity, which is the final value. So, how we report retained earnings? As you know, the best way to report retained earnings is using a statement called retained earnings statement. Sometimes we like to refer to it as the statement of retained earnings. So basically it shows changes in retained earnings. So changes in retained earnings may be reported using one of the following. It could be separate retained earnings statement, or we can combine as combined income and retained earnings statement, or it can be in the statement of stockholders' equity. What we've seen in the first few chapters was the statement of stockholders' equity. One of those things that's also common, especially for smaller businesses, is that they use the retained earnings statement as a separate statement. So when a separate retained earnings statement is prepared, the beginning balance of retained earnings is reported. Then the changes in retained earnings may also be reported in combination with the income statement. So as you can see here, we have this example of retained earnings statement for a company called Telex Incorporated, and it's for the year ended December 31st, year 7. Very similar to the income statement, where it's for the year. It's not for a specific date. So we start with the beginning balance of retained earnings, which is January 1st of year 7. We add to it the net income, then we subtract dividends. And we have here two different types of dividends, the preferred stock dividends and the common stock dividends. We add them together to get the $75,000. We subtract that from the amount of net income to get the amount of net changes in retained earnings. And in this case, it's a positive increase because the amount of net income was more than the dividends, which is 105. We add that to the beginning balance of retained earnings to get the ending balance of retained earnings. So we have retained earnings of December 31st, year 7 to be $350,000. Now let's talk about one more thing called restrictions. So the use of retained earnings for payments of dividends may be restricted by action of a corporation's board of directors. So sometimes companies, they like to restrict the retained earnings because they don't want to distribute it all in the form of dividends. So such restrictions, sometimes called appropriations, so remain part of the retained earnings. So restrictions of retained earnings are classified as either legal, contractual, or discretionary. So for legal, Some state laws may require a restriction of retained earnings. So we have a specific appropriation for um, um, retained earnings that's legally required by the state. It could be a contractual, like a bank that we're acquiring a loan from. They require us to maintain a specific value of retained earnings. So we have a specific restriction on the retained earnings. Let's say cannot go below $100,000. So a corporation may enter into contracts that require restrictions of retained earnings. The most common is usually bank agreements. It could be also discretionary, like a company decides to keep a specific amount of retained earnings for future use, especially if they are expecting some growth. So restriction of retained earnings must be disclosed in the financial statements. Now let's talk about prior year or prior period adjustments. Sometimes, people make mistakes, and we all make mistakes. So an error may arise from a mathematical mistake or from a mistake in applying accounting principles. Such errors may not be discovered within the same period in which they occur. So what happens is that we need to make the adjustment in the future or after the fact. So to do that, the best account that we can adjust it is the retained earnings. So in such cases, the effect of the error should not affect the current period's net income, because it's not fair to correct an error for previous year into the current net income. It might present that the current net income is not really good, even though it was an error from previous period. So instead, the correction of the error, called the prior period adjustment, is reported as an adjustment to the beginning balance of retained earnings. Now let's talk about the statement of stockholders' equity, which is something that we've seen before. So when a corporation has changes in stock and paid-in capital accounts as well as retained earnings, a statement of stockholders' equity is normally prepared. So a statement of stockholders' equity is prepared in a columnar format where each column is a major stockholders' equity classification. Changes in each classification are then described in the left-hand column. So you can see here an example for the statement of stockholders' equity. We have a column for preferred stock, column for common stock, column for additional paid-in capital, column for retained earnings, treasury stock, and total. And then we start with the beginning balance. Then we show what the effect of the net income, which is only on retained earnings, then the effect of dividends on preferred stock, dividends on common stock, and again, these only impact retained earnings. Then if we issued additional common stock, then that would have an impact on common stock and additional paid-in capital. When we buy back treasury stock, then this would be as a negative amount under the column of treasury stock. And then we calculate the total for each column, and then at the very end, this balance should be added together to get the total balance. And it should work on the x-axis and the y-axis. So both of these, like horizontal and the vertical column, should add up to 1.525 or $1,525,000. So let's see an example for Alphabet, which is Google company. Alphabet reports stockholders' equity on its balance sheet. It also includes a statement of stockholders' equity in its financial statements. The stockholders' equity section of Alphabet balance sheet as of December 31st of a recent year looks like that. So we have the stockholders' equity for the balance sheet. We have Class A, B, and C common stock. Each one have less than a penny for par value, for a total of $696 million. The additional paid-in capital, you can see it's significantly higher. So because the stock price is issued for a price that's way higher than its par value, and here it's $49 billion. Accumulated and other comprehensive loss, don't worry about that for now. We have retained earnings, which is $152,000, and then stockholders' equity of $201,000 or $201 billion. So for the statement of stockholders' equity, it should present the same value, the 201, 442, or 201 billion. So you can see here it's the same value, but it's presented in a column for common stock and additional paid-in capital, the accumulated other comprehensive income or loss, which again, don't worry about that for now because that's something material for intermediate accounting. And then we have retained earnings, and then the total column. As you can tell, Alphabet does not have preferred stock, so they only have common stock. And then we have the balance, beginning balance. We have the common stock issued, the purchase of common stock, which is the Treasury, and then net income, and then other things affecting equity to get the ending balance. The last thing in this chapter is to go over some analysis for decision making, and we're going to talk about an important measure that many investors look at, which is called earnings per share. So basically, earnings per share is the amount of net income distributed to each or allocated to each stock. So net income is often used by investors and creditors in evaluating a company's profitability. One ratio for analyzing profitability is the earnings per share of common stock outstanding during a period. This ratio is called earnings per common share or earnings per share. Sometimes we call it the basic earnings per share. Corporations whose stock is traded in a public market must report earnings per common share on their income statement. It's a requirement. So publicly traded companies, they have to present this ratio or this measure on their financial statements. Earnings per share is computed as follows. It's very simple. You get net income from the income statement minus the amount of preferred dividends if the company had preferred stock, and we have to deduct the preferred dividends from the net income, and then we divide that by average number of common shares outstanding. So let's see this example for Facebook again, which is I think nowadays they call it Meta. So the following data in millions except per share amounts, and we don't need to adjust it now, we can just use the numbers in millions. We're taken from the recent financial statements of Facebook. So we have for the recent year net income of 18 billion. Prior year it was 22 billion. The average number of common shares outstanding was already given to us as 2 billion shares. For last year it was about the same value, slightly higher. So by dividing these numbers together, you see that for the recent years, the earnings per share is $6.48, and for the previous year was $77.65. This slide just gives you an idea about the effect of stockholders' equity transactions on earnings per share, so how things would impact the earnings per share. So things like the issuance of common stock. So if we issued more common stock, then in this case the number of shares of common stock would increase and the earnings per share would decrease. For cash dividends, it has no impact on the number of shares of common stock outstanding or the earnings per share for the common stock. For stock dividends, the stock dividends when issued would increase the number of shares of common stock outstanding, but it would decrease the earnings per share. Stock split, the same thing. For treasury stock, when we buy treasury stock, the number of shares of common stock outstanding would decrease and the earnings per share would increase, and of course when we sell the treasury stock, the opposite would happen. So I hope this chapter was useful. Wish you best of luck. Let me know if you have any questions. Thank you.